Ever wondered how to secure a business loan for your business? Today, I'm going to explain the steps and in detail with the process, what documents you need to go to your banker to get the business loan. To get started, it's a lot, right? You're going to get overwhelmed, but understand that the bank needs to see historical data, not future. So if you have a dream and you want to build the next biggest and best thing, or you know your business is going to be here in 2 years from now or next year, that's great for you, but it's not for the bank. The bank's your partner, but they want to see what you did in the past. That's how they figure out if you're credit worthy, if you can borrow money, can you afford it? If you never earned it, you can't pay for it. Don't talk about the future with them. Leave the future out. Talk about what you did and then talk about what you're going to do only when you have historical data. So let's get started. First thing is you need is a pen and paper. To write this down, you need to understand bankers are going to look at 2 years business tax returns. They're going to look at 2 years personal tax returns. So we're in 2025, it's November. You need to come with your 23 and 24 business, 23 and 24 personal tax returns. Non-negotiable. If you don't have it, don't waste your time. You need that. If you're going for a big loan from the bank, $500,000, $1 million, $5 million, you need these documents. In addition, you need something called a year-to-date, YTDs, financial statements. It could be in-house prepared. What is in-house? In-house means your team, your people, you prepared it. You use QuickBooks. You use your proprietary system to prepare it. It's a P&L and balance sheet. P&L's profit and loss. Balance sheet outlines what the current business assets and liabilities are, right? It lists your cash in the bank. It lists your assets. It lists your liabilities, your loans, shareholder debt, whatnot. Then it gives you your retained earnings. It gives you your value of your business at present. Then you need to get a personal financial statement outlining personally what do you have, how much assets do you have, cash in the bank, stocks, equities, bonds, real estate, gold, jewelry, crypto, whatever it is, you list that personally, not your business. Then it lists your debt, your liabilities, your mortgages, your credit cards, your car loans. Car loans are huge. You have a $2,000 car payment, that's going to hurt your debt service. So keep that in mind. Finally, you fill out a debt schedule for the business. Now we're going back to the business. You need to figure out how much debt the business has. You put it down. Do you have an EIDL SBA loan during COVID? Everyone took it. Pretty sure you have one too. You need to talk about, do you have equipment debt? Do you have current bank loans? If not, great. You have no debt. If you do, you have to highlight it. Give us the monthlies on it. Give us the current debt. Give us the interest rate. What did you take out? How far are you? The term of it. It's very in-depth. It's very detailed stuff. So we covered 2 years business, 2 years personal, personal financial statement, a debt schedule, year-to-date financials. You're not off the hook yet. You're not done. You need to give collateral coverage. Everyone looks past this. This is the most important part of the transaction. Not the most, but one of the most important things needed to get the transaction approved. You're going for a line of credit. You're going for a term loan. What's the collateral coverage? Meaning, in case you don't pay the bank, what can they come after and take? There's two forms of collateral. It's usually accounts receivable, meaning that you did the work, you sold the product, and you're waiting for payment from your clients. Banks look up to 90 days. 0 to 90, they'll give you up to 80%, typically industry standard 70 to 75. Once you get that document, also, do you have inventory on hand? Did you buy inventory and waiting to sell it? The bank will give you credit for that at a 50% discount. That's industry standard. You have $1 million in inventory, then guess what? They'll lend you up to $500,000 off of that inventory. In case, God forbid, you don't pay them, they'll come take that inventory from you and then they can sell it back and get back their money. So those are the forms of collaterals that is acceptable to the bank. These are the documents you need to give to a banker. Then the banker will come in and run a cash flow analysis. You'll hear the banker say, we need to run a business debt service coverage. We need to run a global. What are those? Business debt service coverage real quickly means how much income your business has, the EBITDA, and then how much debt you're taking. We run an analysis, and then we come with a ratio. You need to have at least a 1-to-5 debt service ratio to get the money. What that simply means, without any bank jargon or any high level of understanding, is for every dollar you borrow from the bank, you need to have $1.25 to pay back. So if you're borrowing 100,000, you need an income cash flow responsibility $125,000. The bank's giving you 25,000, 25%, $25,000 for 100,000. Runway. You need to have a runway, 25% more to afford that debt. So just think about that. That's the minimum. Some banks want more. Some banks, SBA will go with less, but we're going non-SBA standard 1.25. When all is said and done, some banks will run a global cash flow. So now we overcome the hurdle of a 1.25 business cash flow. What is a global cash flow? Simple. It means you take your business income, you blend it with your personal income, you take your business debt, you blend it with your personal debt. You then bundle it up, run the analysis, come to a global cash flow. What is a global cash flow? You take the best of both, business and personal, assets, liabilities, calculate it, get a global debt service coverage. A global debt service coverage. Keep in mind, that's business income, personal income, business debt, personal debt. Global cash flow is what you need to come to. Some banks look at 1.2, could go all the way to 1.5. Depends on your industry, how much you're borrowing, what's your collateral. There's a lot to go when it goes into the loan process. We at DIT Capital Advisors, we do this all day, every day. We secure financing for our clients. Working 20 years in the industry, we understand which banks only look at global and which banks only look at business debt. Some banks look at both, some banks look at one. You have any questions, leave your comments below. We would love to answer it for you and give you the knowledge that you need to secure the financing that you're looking for in your business.